everyone. Welcome back. I'm Lenny, and this week's module will be focused on credit cards. You may watch the video as often as you like. You should watch the video before our in-class sessions. This will help you to prepare for the class. By participating in this class, you are taking an important first step to building a better financial future for you and your family. Before we begin something new, let's review what we discussed in our last class, borrowing money. We discussed 3 types of loans: consumer installment loans, credit cards, and home loans. Any type of loan that you receive will have cost associated with the loan. Can you remember any of these? Fees and interest, correct. Fees are charged by financial institutions for activities such as reviewing your loan application and servicing the account. Interest is the amount of money a financial institution charges for allowing you to use its money. The interest rate can be either fixed or flexible. Fixed rates stay the same throughout the term of the loan, except in the case of credit cards, where the rate may be changed if the bank gives you required notice. Flexible rates might change during the loan term. The loan agreement will show the details of the rate changes. No matter what type of loan you receive, lenders are required by law to tell you 4 items. First, the amount financed. This is the amount of the loan the lender is letting you borrow. For example, $5,000 for 1 year. Second is the annual percentage rate, or APR. APR is the amount of interest added to the loan. It is usually stated as a percentage. For example, 12%. 12% of a $5,000 loan over 1 year is $600. Third are finance charges. They include items such as interest, service charges, and loan fees. For example, the finance charge total is $600 in interest and $250 in loan fees and service charges. Lastly, the lender must tell you the total payment. This is the amount you will have paid after making all scheduled payments. Using the $5,000 loan as an example, the total payment includes the original amount borrowed, $5,000, plus finance charges. For this loan, the finance charges were $600 in interest, plus $250 in loan fees. This equals $850 in finance charges. The total amount of the loan is $5,850. This video will be focused on credit cards. Many of the terms you hear will be familiar, as we discussed them in our borrowing money module. You are taking an important step toward understanding the value of credit cards by watching this video. Credit can be used to your advantage if you understand how to use it. Remember, credit is the ability to borrow money. When you borrow money on credit, you receive a loan, which is often secured by collateral or a guarantee. We discussed this in class last week. Do you remember what collateral means? Lenders take a risk to lend you money. Therefore, they want to be sure that their money is secure. Collateral is security you provide the lender. Giving the lender collateral, such as your house or car, means that if you cannot repay the loan, you will lose your collateral. You make a promise to pay back the money you borrowed plus interest, which is an extra amount of money you are charged by the bank or credit union to use its money. Fees are an additional cost of borrowing money. Why do you think credit is important? It is also more convenient and safer than carrying large amounts of cash. It also allows you to make a large purchase, like a car or a house, and pay for it over time. Credit can also affect your ability to obtain a job, buy or rent a house, or obtain insurance. Let's look at an example of credit. Maria purchased a used car for $8,000. She paid her loan on time each month and successfully repaid her loan after 3 years. Because her loan payments were on time and in full, she now has good credit. Her good credit will make it easier to borrow money in the future. If you use credit carefully, it can be useful to you. If you have problems using credit responsibly, it will be harder to borrow money in the future. You can borrow money from banks or credit unions. Another way to borrow money is by using a credit card. Before we discuss this, let's talk about the difference between credit cards and debit cards. They look the same, but are very different. Credit cards allow you to borrow money to purchase goods and services and pay the money back later. You must pay at least a portion of the bill every month. This is called a minimum payment. It is often a percentage of your balance. For example, a minimum payment on a $600 balance might be $15. Debit cards are similar to credit cards, except that they are tied to your checking account. When you use them to make a purchase or to withdraw money at the ATM, the money is immediately taken out of your checking account. You need to be sure that you have money in your checking account before you use a debit card. Let's look at the chart to see the big differences between a credit card and a debit card. First, let's look at payments. With a debit card, you buy now and you pay now. With a credit card, you buy now and you pay later. Here, you can see interest charges. With a debit card, there are no interest fees because funds are taken directly from your account. With a credit card, you will pay interest charges if you carry a balance. Both cards charge fees. For the debit card, you will be charged a fee if you use an ATM not owned by your bank. Credit cards charge fees if you do not make payments on time. Some cards have annual fees. There are benefits to each card. Debit cards are easy to use and faster than writing checks. Also, with debit cards, there is no risk of losing large amounts of money. Credit cards allow you to hold payments if charges are disputed. You can also have your credit card refund money if the goods you purchased did not work. By managing your credit card well, you can increase your credit score. Of course, each card also has negatives. Debit cards offer no protection against goods that do not work. Debit cards do not provide a means of paying for unexpected emergencies. Credit cards' greatest concern is overspending. Because some people receive a higher credit limit than they can afford, they spend too much money and cannot pay the monthly payments. Credit cards also have high interest rates. If you only pay the minimum balance, you will spend much more money on goods than the original cost. Last week, we talked about secured and unsecured loans. Do you remember the difference? Secured loans demand collateral. Most credit cards are unsecured. This means you do not have to provide collateral in order to get a credit card. Now let's look at important terms you need to understand in order to get a credit card. Look at the chart on your screen. The first are interest rates. Annual percentage rate, or APR, for purchases. This is the amount of interest you will be charged for purchases. It is usually between 10% and 21%, depending on your credit score. Next is APR for balance transfers. This is the amount of interest you will be charged when you transfer the balance of one credit card to this credit card. It is usually about 15%. Here you see APR for cash advances. This is the amount of interest you will be charged when you take cash from your credit card. It is usually about 22%. Lastly, you see the penalty APR. This is the amount of interest you will be charged for late payments, going over your credit limit, or making a payment that is returned. How can you avoid paying interest on purchases? Pay off your total balance each month. Next, let's look at the fees section. There are 3 categories of fees. The first is setup and maintenance. Some credit cards charge an annual fee. It ranges from $20 to $100, depending on services. Some credit cards charge an account setup fee. It is a one-time fee of about $30. If you encounter this, you should look for another credit card offer. Another fee is an additional card fee. If you approve a new user and want them to have an additional card, it can cost you up to $15 each year. Not all credit cards do this. If you see this, shop around for other offers. An account maintenance fee on closed accounts will be charged if you close an account without paying the total balance. The fee is usually $2.50 a month. Remember that you will also be paying the balance and interest fees on this account. The next category of fees is transaction fees. If you choose to transfer the balance of one credit card to a new one, the new credit card will charge between 3% and 5% of the transfer. The maximum fee is $100. If you take a cash advance on a credit card, you will be charged $5 or 3% of the amount of the cash advance. Taking a cash advance on a credit card is not a good idea. Do not do this. You also may encounter foreign transaction fees. These are charged when you use your credit card in another country. It is usually 2% per transaction. Some credit cards do not charge foreign transaction fees. If you will be traveling, shop around to find a credit card that does not charge foreign transaction fees. The last category is penalty fees. Late payments are charged an extra $35 or more. If you go over your credit limit, you are charged an additional $40. If you make a payment by check and the check is returned, you will pay an additional $35. It is very important that you understand fees and interest charges. These can become very expensive if you do not pay your bills in full and on time. Whether you apply for a loan from the bank or credit card, the lender will review the 4 C's to decide whether you are a good credit risk. In other words, whether you are likely to pay back the loan. The 4 C's are, first, capacity, which is your present and future ability to make your payments. Second, capital. This is the value of your assets and your net worth. Third, character. This is how you have paid your bills or debts in the past. The 4th is collateral, which are property or assets offered to secure the loan. Let's talk about each one of these in more detail. To determine your capacity, the lender may consider, how long have you been in your job? Generally, a lender would like to see that you have held the same job or same type of job for at least a year. The lender may also ask, how much money do you make each month? What are your monthly expenses? A bank will compare the amount you owe and your other monthly expenses with your income. This is called a debt-to-income ratio. It helps determine how much money you can afford to borrow. For capital, the lender may ask, how much money do you have in your checking and savings accounts? Lenders may want to know if you can manage your money well enough to take on a loan. They may ask, do you own a house? Home ownership means you have equity or secured savings in case you cannot pay your credit card bill. However, homeowners also may have additional expenses. The lender may ask, do you have investments or other assets, such as a car? Lenders want to determine the value of your assets. Assets are things you own that have financial value. Lenders will also compare the difference between the value of your assets and the amount of debt you have. This is called net worth. A positive net worth demonstrates your ability to manage your money. Regarding your character, the lender may seek answers to the following questions. Have you had credit in the past? If you have a good credit history of repaying your other loans, you will have an easier time getting your loan request approved. The lender may also want to know, how many credit accounts do you have? If you have never had a credit account, you may have difficulty being approved for a loan. Having a good credit history shows a lender that you can borrow money responsibly. Some lenders may let you prove this without credit history. For example, they might ask for proof that you pay your rent and utilities and phone bills on time, or that you make regular deposits to a savings account. They will ask, have you ever filed for bankruptcy? Had any outstanding judgments? Have you had property repossessed or foreclosed upon? Have you made late payments? If you answer yes to any of these questions, you will likely have more difficulty being approved for a loan. However, some lenders will ask you to explain what happened. Depending on your circumstances, a lender might be willing to approve your loan request. To determine what collateral you have, the lender may ask, do you have assets to secure the loan beyond your capacity to pay it off? Collateral is security you provide to the lender. As we have seen, giving the lender collateral means that you pledge an asset that you own, such as your home or your car. This is pledged to the lender with the agreement that it will be the repayment source in case you cannot repay the loan. Before our next class, I want you to think about the 4 C's. Would you be able to answer these questions? See you next week.